Alright, so let's continue our discussion of credit risk. And we'll get into mitigations. We talked about measurement, and measurement has to do with probability, which is our frequency, the probability of default, and severity, which is severity is 1 minus the recovery rates. So mitigation, I don't want to get too much in mitigation because you're doing this for paper 1, but risk limits, or risk budget, concentration limits, those are very important. How much risk you can have in any one company or any one industry or any one particular risk. I remember at UTSA, I had to come up with risk limits for our portfolios, and we wanted to include stocks, bonds, real estate, reinsurers, any relationship where if a firm went insolvent, it would cause UTSA. Set the limits based on credit ratings, took it to the CEO, and the CEO, his answer was always, that's too high, reduce it, that's too high, reduce it. And I finally had to come to him and say, there is nothing I can do. He was telling me go back and work on it more, but there's nothing for me to work on. He just needed to pick a number, and he picked a very low number. And when we did our lists, I would get every entity throughout UTSA would give me their top 50 exposures. I would take those top 50 exposures and combine them. So I would count, whoever had exposure to this particular name, I'd bring them together so I could get a list of UTSA's top 10 exposures. And when the CEO gave us the new requirements, boy, our bond portfolio managers were really upset. They were used to buying 60, 70 bonds. And with this new requirement, they were going to buy a few hundred bonds. And they were really upset. They said, oh, wow, this guy doesn't know what he's talking about. These are too restrictive. But before we did that exercise, one of our top exposures, I can't remember where it was on the list, but very high up, was an entity called Enron. We had a large exposure to Enron. When the CEO changed the rules, our exposure to Enron dropped dramatically. And then Enron went under, and I remember talking to the bond portfolio managers then, thinking, well, maybe this guy knows what he's talking about. But he saved us a tremendous amount of money by making us separate out those exposures. The problem was when we fixed our bond portfolio, then our largest exposures, our top 10, was dominated by reinsurance companies. Reinsurers essentially provide insurance to insurance companies, and firms like Swiss Re and Munich Re and Gen Re, these massive reinsurance companies, they were top on our list. And then we had the problem of what do we do about them, given that the reinsurance industry was concentrating. There weren't enough players in the market. So it was going through this exercise of saying, how much risk do you want to take? You have to come up with the risk limits, and it's a very subjective thing. And I got to go through that exercise with UTSA, very interesting. Strong covenants, and then credit default swaps. I think a lot of y'all are seeing credit default swaps. So that's the default risk. And if we add in the issue of downgrade risk, that's when we get in the area of price discovery. Bonds do not trade the way stocks do. Bonds don't trade every day. There's some bonds that hardly ever trade, but you still have to put a price on them. And so what price discovery with the bond is, you have an idea what the price is because you have models. You can look at other bonds. You can look at the price of other sectors and try to get a sense what's going on with the bond. And then someone might sell a piece of your bond from another entity, and that gives you a current price. But if bonds don't trade every day, you're guessing what the market value is. And so price discovery, I remember at UTSA, you would call the broker and say, we have to price our mutual fund. We need a price for ABC bond. And they say, oh, that bond's trading for 92. So you'd write the price in at 92. And then the portfolio manager would say, well, 92 is a good price. I want to sell this bond. So you call the broker back and say, we need a price for this bond, but we want to sell it. And the broker says, oh, well, I gave you a price that was a model price. That's the theoretical price for the bond. But if you want to actually sell it in a year like 2008 where there are no buyers, the theoretical price might be 92, but the true price, what you can get for this bond, might be 60 or 50. That's how bad 2008 was. We had bonds that we had on our books at 92, and then someone would try to sell some of that bond and suddenly we would have to write the bonds price down to 60 or 50. It was a horrible year. You don't really notice that in normal markets, but in a year like 2008, you certainly do. I wanted to give you some sense of that by showing this chart, this Excel file. And what I did here, I wanted to compare a mutual fund to an ETF. A mutual fund prices its portfolio at the end of every day. If bonds have traded and it's got a market price, it does it at the market price. But if a bond hasn't traded in a while, the mutual fund will use a theoretical price, maybe a price provided by a broker. An ETF, however, does have a price. An ETF and its exchange traded fund, it is traded every day. It does have bid and ask prices. We do know what its value is. And its market price is not going to reflect theoretical prices. It's going to reflect the price that people actually believe is going on in the market. So it will be much more sensitive to what's going on in the market than the mutual fund. And as you look at these two, they start exactly, I had them both start at $1, and they both end at exactly the same, almost exact same price, 165 and 166. But you notice the ETF is much more volatile. And right now in the middle of coronavirus, you're noticing the price discovery, because with the coronavirus, you notice they move pretty much together, and then suddenly in this last financial crisis, the mutual fund stayed fairly stable, but the ETF dropped dramatically. And you can see there's a little bit of relationship. They're both coming down, but the ETF is much more volatile. If I had today in there, today the ETF was up quite a bit. I doubt that the mutual fund will trade that much. I just don't have closing prices yet. That is what price discovery is. Theoretical prices versus actual market prices. I remember at UTSA, I was on a committee that had to meet anytime there was a major change in a bond price. That committee did not meet at all the first 2 years I was on the committee. The third year, which is 2008, we were meeting almost every day, because UTSA would have a bond that was pricing based off of theoretical prices, and someone somewhere in a small hedge fund or a small portfolio would sell a very small piece of that bond, and suddenly a bond we had priced at 92 just had a market price at 60. And we had to figure out, what do we do? Do we go with that market price, because that could have been a desperate seller, they just needed some cash and they didn't care what price they got? Or do we go with the theoretical price or with the actual live price that we have? And it was difficult, a very difficult year for the bond market. And we're seeing something somewhat similar today, the last few days. And I think this is a good way to think about price discovery. How much are the mutual funds moving together versus ETFs? When you see the two of those separate, there's a good chance that there's some price discovery going in the bond market. It's not that the ETF is trading all those bonds, but the person trading the ETF is trying to get a sense of the true value of those underlying bonds, and that's how they're pricing their ETF. So you might look at price discovery in on the internet and just see. You might have to type the word bond and then price discovery. And I think several articles will come up. I'm just looking on my other computer. Investopedia has something, and yes, and in fact, there's an article that I saw today while I was looking over the markets. It said bond ETF price discovery is a mess right now. So it's the price discovery of the bonds themselves, and it's the price discovery of the ETF itself. Bond ETFs, they trade whatever the price is. They trade more frequently than the bonds inside the ETF trade. So you might look at that article. It's an article by Insight. You'll find it. Bond ETF price discovery is a mess right now. It's written by a CFA named Elizabeth Kashner. It looks like a very interesting article. I may have to read it after I finish doing this session. All right, so there's credit risk. What I want to do real quickly is show you the question from the last exam on credit risk. It's actually a very simple question, but for some reason students don't do as well on it as I would like. I give you this this table that I showed you last session, And here's the question. Below is a summary of the cumulative default rates. Historical recovery rates have been as high as 60% for AAA rated bonds, but tend to be about 40% for other bonds. If the current spread on BBB rated 10-year corporate bonds is 160 basis points, comment on the adequacy of this spread. Is 160 basis points enough? So we're talking about a BBB bond for 10 years. BBB bond, 10 years, remember that's a 7.11%. So you have your expected annual defaults is going to equal that 10-year cumulative, the 0.07711. Convert this into decimals, 7.11% or 0.077711 divided by 10, and that's going to equal 0.00711. So your expected credit losses are going to be that annual default times 1 minus the recovery, which will equal 0.00711 times 1 minus 0.4, because you have a 40% recovery. Remember, the recovery is around 40%. And so when you do that, you get, and then convert it into basis points, 43 basis points. It will come out to be 0.0043. Then you multiply that 0.0043 times 10,000. And that gives you 43 basis points. How many basis points is this bond paying? It's paying 160 basis points. So you'll make an additional 160 basis points a year on a bond that's expecting credit losses of 43 basis points a year. You're being adequately so the way to get the exact answer is we're adequately, more than adequately, I guess we should say, more than adequately compensated for default risk, but some of the 160 basis points spread should also include downgrade risk. So it looks like you're getting compensated for your risk, but there is that additional risk of downgrade risk. Also, just when you go into a recession or something like the coronavirus, these bonds will definitely sell off more than other bonds. I mean, BBB are going to sell off more than AAA and sell off more than Treasuries. So there is some price risk here, but just looking purely at default risk, the 160 basis points is almost 4 times what your expected losses would be on just for credit risk. All right, so that's it for credit risk. Credit risk is pretty straightforward. You saw how complex it was with your banks, no question. So there's a lot more to it, and it's not complicated. It's just very detailed oriented and requires a lot of systems. You have to look at it bond by bond. One thing I didn't mention on measurement, we didn't talk about aging schedules, and that's something you would definitely do, looking at aging schedules to see how many bonds or 30 reserves is their estimate of losses, even though they may not have actual defaults yet. All right, that's it for credit risk. Let's jump into another risk, which is basis risk or tracking risk. Basis risk is one when you're trying to hedge something, the instrument that you're using to hedge does not behave as expected. I gave you an example of basis risk when we talked about the pension plan at UTSA. Remember, we invested in an interest rate swap that would go up in value when interest rates fell, so that it would offset the liability that would go up when interest rates fell. However, in 2008, our liability was falling because corporate spreads were gapping out, and our discount rate was based on corporate spreads. So our liability was actually coming down in value, but our swaps are going up in value. So we had basis risk or tracking risk, but in that case, it actually helped us. Our hedge vehicle was making money when what we were hedging was losing money. So that's the definition. It's a difference between what you hedge and what you're hedging with, your hedge vehicle, what you're hedging and what you're hedging with. You measure it using what's called tracking error. Now remember, we talked about tracking error for the project. You may not have seen those videos yet, but when you watch those videos, you are going to calculate the tracking error of a mutual fund. And that's just the difference between your mutual fund's return and the return of its underlying benchmark. So tracking error has a couple of meanings, but here it's just a standard deviation of the difference between what you are hedging and the hedge itself. We usually use value at risk to measure that. So you use tracking error and then you use parametric value at risk to try to see how far could these two things get apart. And you need to consider, and we'll talk about a case later specifically related to the oil industry, you need to consider the difference between the hedging instrument and what's being hedged in different environments, because some things react differently in different environments. So you might say, wow, I looked historically and this hedge works really well. Well, if you don't go back to the 70s with the high inflationary environments, you might find that when inflation is a problem, your hedge acts very differently than it does in other times. How do you mitigate this? This is a tough one to mitigate, but it just requires a lot of testing. Make sure you run a lot of scenarios. Make sure you're looking at the specific crisis you're worried about. So go back in time and try to find a comparable period to what you are worried about and see if the hedge actually works there. You might change your hedge ratio. I talked about with my USA's pension plan, I was worried about inflation risk, so that actually made me change the way I would hedge interest rate risk to actually not hedge it perfectly, because interest rate risk and inflation risks tend to move in opposite directions. So, and then try to match your hedge as closely as possible. One of the cases we're going to study later in the class is a firm called MG. And that case is often referred to as speculation in the basis. And we'll see how this was very much a tracking risk case. Very interesting case. It's one of the most famous tracking risk or basis risk cases there are out there. But yeah, basis risk, tracking risk, that's a huge one, but very hard to manage. You'll have this in your career. I cannot emphasize enough, over test. Look at all scenarios, look at all environments. Just make sure you don't tell your boss, hey, we're hedged, everything's fine, and then something unusual happens and suddenly you have something blow up and your boss is sleeping well when he or she probably should be worried. All right, that's basis risk. Now, one thing I warn you as we go through these risks, the way I do this on the final, we're probably going to have to final be open book, so it won't be quite as stressful as my normal class. But as we go through this, what I like to do in the final is have you pick one of the major risks being interest rate risk, price risk, and credit risk, and 2 or 3 of the minor risks like basis risk, like liquidity risk, and pick them to fully discuss, to have a full answer. So you may be thinking about that as we go through this. Which of these risks most appeal to you that you'd most want to talk about in an essay? So it gets to our next risk, which is model risk. Again, define, measure, mitigate. Defining model risk is you're using a model to simplify life, real life, but the model doesn't really reflect real life. Your formulas are too simplified. They don't capture things. I heard this at I used to speak at actuarial conferences, and one of the actuaries used this phrase, garbage in, gospel out. And what that means is the model is so complicated, the formulas are so complex, people just assume, wow, this model must be really good because it's so complicated, and yet it's not very good at all. It's just actually not matching reality anywhere close. And we tend to be fooled by complexity. How do you measure this? The measurement is just how complex is your model. And the more complex your model is, the more likely there is that there's errors. Most models have errors in them. So there's not much you can do about it. One thing I do say and that's in the mitigation. And I learned this. Oh, I learned this. I hope y'all all are listening closely here, because this is so important. One way you find out if a model has a problem is test the extremes. So if your model is testing interest rates, then have interest rates go up to 15, 16%. Test them at the extreme. If oil prices is your issue, have oil prices fall down to $5 or go up to $250. Test the extremes. Models tend to break down at the extremes, and it becomes really obvious there's something wrong with the model when you test an extreme case and the losses don't look nearly large enough, and you think, wait, something's going on here. That's about all you can do. I remember one model we had where the CEO in a meeting says, I don't think your numbers are right. And I said, oh, we tested it, I think it's right. But what he was saying sure seemed like we had a problem. I went back and called the actuary who had actually built the model, and she looked at it, and sure enough, we had an error in the model. And it's just, boy, it's just a problem with what we do in finance. We have these models that are so complex, the formulas go on forever, and boy, we just, it's going to happen to you. It happens to everybody. Double check, triple check your models. Have someone else check your models. I remember one model I was running for USA's asset allocation. This is the model we use to move over $15 billion in assets. And I just in passing mentioned to the CFO, we're about to move about $15 billion in investments based on a model that I built and no one else has looked at. And the CFO's like, yeah, we need to get someone down to Ron's office and look at this model. No one ever came and checked it. They were lying entirely on me and that my model was good. I thought it was good. I doubled and triple checked it, but no one ever looked over my shoulder to see what I was doing. Clearly define your Excel model as you go. Take extra time to build your model. Put all your assumptions in one place. Make sure you have a lot of comment boxes. Break up your formulas into steps. Document as you go. I so strongly recommend this as well. Make your model such that the next time you load it, someone else besides you can clearly follow what you did. It's all obvious. It's all set up. I've seen some models that students have sent me and they want my comments, and I'm just like, I can't give you any comments. Your model is so complex. You have formulas that are going on for 200, 300 characters. It takes me too long just to figure out what you're doing. Break it up, make it more obvious. There is a good book on this, A Signal in the Noise, Why So Many Predictions Fail. I do recommend it. It's a book by Nick Silver that you might have heard of, a famous guy. And there's other books you can read on. We'll talk about Nissim Taleb and some of his comments about modeling and finance and our mistakes we make. You need to read a lot on this. You will be building a lot of models, whether you are an actuary or a finance major. We make a lot of mistakes in our models. We need to be much more, a little less optimistic, a little less sure of ourselves, and just realize we make a lot of mistakes in here. Here's a couple of quotes I like about models. This first one especially I really like. All models are wrong. Some models are useful. One thing we're going to definitely do later is talk about this guy, Doug Hubbard. I'm going to have you watch one of his videos. Oh, you should read everything Doug Hubbard has written, or if you don't want to read, go out and watch his YouTubes. You'll have to watch one of his YouTubes as part of our class. I'll give that to you. But he talks a lot about modeling and the value of modeling and how we get around the fact that models have issues with them. The other one is models are not evidence. So you run a model and it says, hey, this is what we should do. That model is not evidence. It's just someone's building their logic. So evidence is history, and then the best evidence is the future. How do things actually work out? The model itself is not evidence. It's simply responding to whatever assumptions and data you put into it. All right, so here's some quotes here. I'm not going to read them to you, but there's some quotes by Doug Hubbard. He says, perhaps much effort is spent on seemingly sophisticated models, but there is no objective, measurable evidence that they improve intuition. Doing nothing, this is his point, doing nothing about risk management is actually not the worst case. He says the worst case is building a complicated model everybody trusts that has no basis, no evidence backing it. One thing he's really critical of is heat maps. And when we get to Douglas Hubbard, I'll talk about heat maps. We used heat maps at USAA. I do not like them. I don't think they work. I think it gives you a false sense that you're doing something when you're really not doing anything. But we'll get into that and talk about it. I really like Doug Hubbard and what he has to write, so we'll get into that. All right, next session, we'll talk about legal risk and a few others, these small risks. So I'll stop it there because the video is getting a little bit long.